Here's the #1 tax plan specifically geared towards high-earning individuals or executives with a spouse that doesn't have that high-earning income. Typically what we do. Now, to properly structure something like this, the average firms will charge over $10,000 usually to properly implement it. So what does it look like? Let's say you're a high earner. The more money you make, the more you'll save. But let's say you are $250,000 or higher, and you have a spouse that doesn't have any active income. Your spouse is stay at home. And let's say this is a W-2. So traditionally, there's absolutely nothing you can do to offset your active wage income. Unreimbursed employee expenses are a thing of the past. IRAs, 401k, there's nothing. That's not savings, it's deferring. So outside of like some health savings or something, there is nothing you can do. So what is the most popular structure so you can offset some of this income? Now, this structure is extremely complex on the back end and it requires a lot of documentation. But I'm going to explain a $10,000 plan in a couple of minutes, but this is what it looks like. We start using proper structure and leverage, and of course bankability. And if you use the Diamond Wealth Real Estate Systems way of purchasing, you're going to minimize that out-of-pocket capital. Essentially, you're purchasing real estate under the spouse's name. The more real estate, the better. Now you'd say why you would do it. Well, outside of the obvious, because there's 7 different ways of making money in real estate, there is actually one way that you can offset, especially year one, some of that income. And what is it? You will have to make your spouse a real estate professional. Why is they and what is it? It's extremely complex. Read the rules. Some of the major rules are: should have to spend, the spouse has to spend 750 hours per year and half the time or more in it, among other requirements. License, real estate license, it's not required. And why would you want to do this? Why would you do it? The reason is because when you have the real estate professional designation, the losses, income, it is now considered active. Same as your job. Meaning, if you have losses, which you should, especially year one, because if you've used proper structure and leverage, especially bankability mindset application to it, you have minimized your out-of-pocket expense per house. You've minimized it. Meaning you can use the bank's money in the calculation. You get to depreciate them. Residential is 27.5 years, which is 330 months, right? So let's say you have a $100,000 year one loss, and you're in the 30% bracket. This means that you can save year one $30,000 off this tax bill. Because of the depreciation, the more assets you have, the better off you'll be. Make sure the real estate professional is very well documented. There's a lot of rules. I'm going to put some of them there. I also have a download. You can get it and read it. You can go a step further if that's not enough. A lot of people would consider the additional step, which is doing a cost segregation study, essentially accelerating the depreciation. So it's not 27.5 and you make it between 5 and 7, which is going to push more money at year one loss. Now remember, the basis of that asset is now shrinking. So if you sell it, you'll be hit with a huge recapture of depreciation bill. So don't ever sell. You can 1031 exchange into more, take loans against it, but don't sell. That's always the rule. But let's say it's 200,000, then you save 60. The more money you make, the better off you'll be, but it's typically year one. So then the system's going to keep making you buy more and more real estate so you can have more and more front-loaded losses. It's a one-time, so the more you buy, the more you will theoretically save in that year. It is great for someone who believes in real estate and wants to get into it. I wouldn't just get into this particular thing to save on that one-time fee. Saving $30,000 and $60,000 is great. It's a one-time. It's very complex. So you must believe in real estate and in the 7 ways and adopt bankability mindset to do it. But if you're considering it anyway, it's a great way to offset some of that bill.